Hello, good morning. Happy Tuesday. My name's Sarah Page. I'm the owner of SAP Virtual Resources. I offer virtual accounting, bookkeeping, payroll services to small, mid-sized companies. I have over 25 years of experience in a number of different markets, from janitorial supplies to newspaper advertising to oil and gas, and my last iteration in the corporate world was over 10 years in mechanical construction. So I do specialize in small to medium-sized construction companies, but I work with all small businesses. So today I want to talk about owner's pay for an LLC versus an S corp. And this has been a question that has come up a lot lately, is how do you pay yourself if you own a business? And it depends on the way the business is set up. So if you have a simple LLC that's a single owned or a partnership, you cannot take a payroll. You cannot expense that payroll, expense the payroll taxes from the business. As an owner, a single owner, you would just write yourself a check. That is a draw on the business. It does not come off of your net income. It comes off of the balance sheet after your net income rolls into the balance sheet. So it does not bring down the taxable amount of your business. That net income, you're still paying the self-employment taxes and things on, because it is before you take your owner draws. Same thing with a partnership, is you really accept it with a little twist. A partner can't take draws out that's more than their equity. So if you have a partner that works in the business, they also can't be on payroll, but they can have guaranteed payments. So let's say you have two partners, one's more of a silent partner that just ponied up the money. The other person is in the business working day to day. They're going to pay themselves a salary based on the work they're putting into the business. And that's a guaranteed payment. It does expense off of profit and loss, so it does bring down that net income amount, your profits. The other owner or the other partner can only take a draw against their share of the equity in the business. And then you have the ability to have that company taxed as an S corp by filing a form with the IRS. And let me give you the actual form name. It's the IRS form 2553. And you have to make that change. Like if you want to have it for your 2024 taxes, you need to do filing that form here fairly soon. So, because you can't wait till the end of the year and go, oh, I want it to be an S corp last year. They don't let you do that. I guess because they figure you figured out which way you could get your taxes less, and they don't want to offer you that option. But you file that, you get permission to be taxed as an S corp. Once you have that permission, make sure you get that letter from the IRS to prove that you received, they received your application, and that you have that approval. You can now be paid as a payroll employee. You can go into the payroll system. Your payroll can be expensed. Your payroll taxes can be expensed. Basically, you turn yourself into a W-2 employee of that business. And there's a lot of back and forth about the best time to do it. I have heard until you have a net income of over 40,000, or until your net profit is going to be more than what you are planning on paying yourself as a salary. And once you have an S corp, you do have to pay yourself out of salary. It's considered reasonable. So if you want to pay yourself once a month, if you do have employees that are on a 2-week or a 1-week, you can be in that same schedule, but you need to have a reasonable. So let's say your business makes $500,000 in profit for the year. They might not consider it reasonable if your income happens to be $500,000. But they also might not consider it reasonable if your income is $10 a month. So they leave it really open to interpretation. They don't say you have to pay yourself 30,000 a year up to 100,000 a year. They don't give you that. They just say it has to be reasonable. I'm assuming that one of their reasonable would be don't wipe out your entire tax burden. So that is some information on when you set up to pay yourself. Make sure you're paying yourself properly. Because if you do pay yourself as a payroll employee with the taxes taken out and stuff, when you're not eligible for that, it can cause penalties. It can, if you're audited, because you are not able to take that discount, that deduction off of your profits, off of your net income. And so the way to fix that, and like I said, it's come up frequently this year, is you need to amend your W-2s, remove that employee off of those W-2 records, which is also then correcting the W-3, which is your cover letter for the W-2s. It is amending your 941s. It is amending your 940. It's amending your state unemployment reports. It is a lot of work. And if it needs to be cleaned up, you're going to be paying somebody a fairly decent amount of money to go and refile all those reports with the amendments. So any money that you were hoping to save, you'll just end up paying for. And a lot of times it happens because people don't know the proper way to pay an owner when you're just starting out. So I hope this will help. If you have more questions, if you need more clarification, please reach out. Let's set up a time to chat. I'd rather we get this figured out early in the year or as you're starting a business, if you're listening to this later, than at the end of the year when now you have, unfortunately, a mess that needs to be cleaned up and you're paying a premium price for somebody to do that for you. So reach out. Let's have a conversation. Let's make sure you're starting off on the best foot to make your life as easy as possible and not have to worry about any penalties that could come your way from this. So enjoy the rest of your week. I will see you next Tuesday.